As usual, it is good practice to at least mark the IPO price, if not the wider range around the IPO price. Particularly in the first few years a stock trades on the market. In this case, Facebook had a bearish start, soon give way to an uptrend, with plenty of gap ups. Here is an excellent example of how significant levels can be the site of repeated swing points and gaps. In this case, some round price levels run precisely through or very near the real bodies of candles that form swing points and gap levels. The uptrend has been very stable in the long term. It has a neat uptrend line running through clear swing points with high volume. Upswing points are often very close to the site of gap up fills, at the precise levels that swiftly reverse rolls to become even more valid support and resistance ranges. Such price action often marks horizontal ranges that last for several weeks. They highlight a shape similar to stair steps to highlight an aggressive but stable uptrend such as this one. November begins with highly bearish 3 methods falling price action. That is bolstered by a gap down which is not immediately filled. This is more than adequate to breach the strong uptrend line. So far, the November drop is a short-term bearish spike that has broken the trajectory of the long-term uptrend. After first contact with the major 116.80 area, there was immediate support as bearish volume and price action began to significantly subside. Naturally, market participants with short, medium, and long-term outlooks on Facebook stock will be watching the 116.80 support closely to see if bearish sentiment can be reversed to regain longer-term bullish sentiment closer to the original uptrend line. As usual, there is pattern formation potential around such major events on the chart. A lower uptrend line reveals a slight incline, making the case for a triple bottom in favor of filling in the gap down. However, there are also a series of downswing points, 3 declined downswings to be precise, since the minor bounce following the November gap down. This can make the case for price action of a potential descending triangle that still has a relatively flat base, and only a third possible upswing in development. Just as the new year begins, it quickly becomes clear the descending triangle fails. The descending trend line is definitively passed by a gradual increase in bullish volume and consecutive closes higher. This outlines 3 marching soldiers price action in progress. Then 122 around the gap down candle's opening price is passed, to simultaneously begin filling in the gap. At the same time, the wider gap down range is transitioning into a triple bottom range. Now, as long as trading in the next week stays over 122, there can certainly be a return to the overall long-term uptrend. It is indeed a strong gap fill, as bullish price action and volume proceed on the same aggressive but stable incline. It was actually not necessary to have plotted the lower uptrend line earlier, though it should still be noted the upswings in the triple bottom range do present a slight incline to add additional bullish sentiment. When the gap is filled, the candles are a blend of 3 marching soldiers and 3 methods rising. There are candles with gaps between real bodies, presenting strength, but the gaps aren't too large, and most candles generally close above the previous day's close, even when real body ranges overlap. The one bearish star on January 10th acts as a minor resting phase in a very small 3 methods rising formation. It is quickly neutralized by the next candle closing higher. This minor feature relieves selling pressure in the very short term to keep the steep incline stable. Volume is above normal but not exceedingly high. This is actually a good sign of stability. As seen before, overwhelmingly large spikes are often not sustainable for long. The moderate increase in green over the past few weeks summarizes a stable reversal originating from the failed descending triangle transitioning into a triple bottom, with a minor incline. The start of 2017 also sees the overall decline in bearish volume, and a gradual increase in bullish volume, to mark the transition away from a descending triangle that would normally have significant levels of sustained selling volume to breach the triangle's support range. It also helps the closing prices were relatively contained within the outlines of the failed descending triangle and the successful triple bottom. This also presents an example where a triple bottom is found in more of a continuation context of an uptrend, in addition to reversing the short-lived bearish spike. This is in contrast to the triple bottom often forming to reverse major downtrends, though this is normal given bullish context after the first few bearish weeks following the IPO. The heavily bullish context in early 2017 allowed for a relatively smooth gap fill that still did see temporary resistance as price slowed upon contact with 127.50. Eventually, a major peak is reached to open an exceedingly large gap down. Naturally, the gap down and gap down fill ranges are quite wide due to high volatility. Here there are compromises from moderate-sized gaps, and strict theory as price levels are rounded off but do not necessarily touch open, high, low, and close prices, though the levels are quite close to such price levels, with the gap down and gap fill candles being quite large, but more precise than the large price fluctuations that appear in August for a wider gap down range. Upswings and downswings following the gap down could provide support and resistance, but some may choose not to mark them immediately to keep the chart from being cluttered. This isn't much of an issue as Facebook continues to decline in the following weeks, to leave the 180s to 170s ranges behind for what will likely be a considerable amount of time given the bearish context of a long-term decline. 127.50 returns as a major support to form a decisive bullish reversal, with a declined double bottom that is slow to complete prior to the late January gap up, which was largely in reaction to the January 30th quarterly report. As usual, market reaction to earnings reports can't consistently be reliably predicted. After the normal flat trading in late January, the market could have easily gapped back down if the reaction was negative, and that would have likely been down to 127.50. The double bottom did have a part in the gap up, but a bullish formation on the chart doesn't always guarantee a catalyst event like an earnings report will result in a price jump in the near future. More recently, there's been a great example of a gap up fill that did provide support but was breached by major selling starting June. It pushes under the previous large gap down range of 180 to 175.50. That is reused again for the next minor gap up in late June that is filled later in August. Support continues holding towards October to establish a solid foundation before the return back into the 200s for the larger gap down fill. There is some slowdown that is to be expected at a gap fill that happens to be at all-time highs. Selling pressure, while constant, is not exceedingly high, and only at normal levels. Interestingly, the minor gap up from early January 2020 is filled with a large morning star candle pattern that itself has large gaps from a short-term perspective. Remember, almost exactly a year ago there was a gap up, mainly from an earnings report to complete a double bottom. Facebook had an earnings report scheduled for January 29th, 2020, 1 hour after the market closed, and that is an important note to take into account. Again, market reaction to catalyst events like earnings reports can be highly variable and largely unpredictable. In this case, it is the exact opposite of 2019. Here there is a double top, completed by a gap down. Bullish candles in the lead up to the earnings report and the gap down were highly misleading. Candle price action before an earnings report or other catalyst event cannot be used as a reliable predictor of how the market will react and which direction a gap could form. A steep drop was possible in early 2020 even before the broader stock market decline, because Facebook was still struggling at record highs upon filling in the large 2018 gap down. All the developments in early 2020 highlight how chart patterns, candles, and general price action formations can be invalidated by major catalyst events and the broader market. It is also a good reminder for traders and investors to be extra cautious in light of such events, in addition to the normal caution that should always be exercised as a chart begins to return and surpass record highs. Nonetheless, Facebook does recover after a rapid decline, and the previous ranges remain helpful in identifying minor downswings prior to some bullish breaks that often have large green real-bodied candles closing right above what were once previous resistance areas. Naturally, the old gap down fill and record high range now become an important support, following a decisive break and natural pullback. Bearish volume and price action return but are not exceedingly high at this current time. Close attention should still be paid here, especially as a potential double top could complete if support fails in the near future. This could also be called a potential concave triple top, but as usual that is a small detail, especially since the range is quite compact. Now here is a more strict potential triple top. The lower boundary of key support at the long-time 214.50 level has been breached temporarily, but there hasn't been a decisive close under it yet. As of now, support holds to delay a triple top from completing despite the highly bearish and volatile price action. Normally, the potential triple top would have completed upon breaking under 222.50, since it is a clear lower boundary and temporary support. However, support has extended down to at least 214.50 due to the prior significance of this area, and the minor gap up on May 20th, to a lesser extent. The importance of these factors has been demonstrated by the volatile price action of the three candles that ended June to develop a sharp and distinct bullish reversal at the right time and right place to avoid a major downtrend. The failed triple top had all the right characteristics in volume and price action, but still failed due to the crucial bullish reversal off previous record highs to serve as a good reminder that patterns are never a complete guarantee of particular price action. Short-term developments placed in broader context should always be watched closely, down to the last moment before conclusively declaring a pattern to be completed successfully or failed. Later, there is a less common variant of a very compact but strict double top to mark new highs around the 300 area. There is expected opposition due in part to being such a clear round number. From this point, a steady downtrend emerges to place the area around 240.90 as a key support range. That can be more detailed if the August gap up range is marked, though at this point 240.90 is adequate, as it is the clear prior record high from the distinct outline of the failed triple top.